I didn't see that. Yeah, I didn't see that.
Okay, let's go ahead and get started. It's 8:01. I don't know, we're still missing 3 or 4 people at least. So, all right. So what we're going to do, we're going to start off today, and kind of this first topic is to deal with capital structure. And specifically, capital structure is kind of where the money is coming from for a deal, and then how it sort of can evolve over time. And potentially you can obviously be earning equity or building up equity in a property, and then how that may translate into the possibility of being able to refinance out of a deal, okay? So in a typical deal, as we have talked about in this class, you know, you've got 2 primary sources of capital here. And so let's say that we've got a deal, 80% we're going to borrow, that's going to be our debt, 20% is going to be our equity, all right? So for a total of, obviously, 100% for the total deal, all right? So that would mean we have an 80% loan-to-value ratio, that sort of thing. Now, over our holding period, 2 things can occur. Well, more than 2 things, but at least 2 things can occur. One is, the longer we hold the property, assuming we have a normal mortgage, what is happening to that mortgage? If we're making payments, we're paying down the principal on that mortgage. Well, that's what we call equity buildup. So that in one sense, if you sort of think about it, let's say we had a 15-year mortgage, okay? At the end of 15 years, we have paid off the mortgage. So in essence, we have gone from 20% equity to what percent equity? Really 100, okay? But that 80% was really built up equity, okay? In the sense of we paid it down over time. Okay, does that make sense? But we also have to think about what happens during that same time period whenever the property goes up in value, okay? So you can have obviously 2 very positive things going on. One, you're paying down the balance, and number 2, the property is going up in value. Therefore, over time, you know, whenever you go to once again, maybe refinance the property at some point in the future, you can potentially cash out substantial equity, more than maybe potentially in some cases you actually put into the deal to begin with, without having to sell the property, okay? So let's talk a little bit about how that sort of would work. So let's just take this 80% loan. All right, so first of all, give me a dollar amount of the deal.
$1 million.
$1 million. Nice round number, I love it. All right, so $1 million. All right, so of that, 80% is going to be debt. So that's going to mean a loan of $800,000. All right. So let's just say that we do this, we'll go ahead and set it up, what the heck, for 12 payments per year. $800,000 loan. Okay, give me an interest rate on the loan.
5%.
5%. Okay, give me a term. 15?
Yeah.
Okay. And now let's go ahead and solve initially for what our payment's going to be for that. All right.
On a monthly or the yearly?
This is monthly. 12 payments per year. Yeah. So 800,000 is our present value. 5% is our interest rate. 15 years. is our term. So our monthly payment,
63, 26, 35.
yep, 63, 26, 35. Okay, but that's not what we need. What we want to know now is, okay, this deal that we're wanting to kind of sort of take a look at what's happening to the capital structure over time. Let's say that we sell this property off at the end of 5 years, okay? So what we need to know is what is the balance on this loan at the end of 5 years. Does everybody follow me on that conceptually?
Yes.
Okay, so to do that, using the financial calculator, you simply follow on with what you've done here, and you're going to put in one input, what?
60.
60 for 60 months. 5 years times 12 months would be 60 months. Shift,
Or more.
amortize, and then you're going to hit equal, equal, and equal. And we'll talk about each of those real quickly. All right, so first of all, let's just get it put in. All right, so the first time we hit equal, 204,543.27. That is going to be the principal. You hit equal again, 176,037.67. That's going to be the interest paid, and then our balance 596,456.73 is our balance. Okay, so having just done that, and what, let me kind of scoot this up just a little bit so those of you in the back can sort of see. Okay,
Just, where's the armor in this thing?
far right, top,
Find it, yeah,
yep,
yeah.
right under the fifth key over on top row.
Yeah, yeah.
Okay, so you do this, what this is telling us is the calculator is saying, okay, for the first 60 months or the first 5 years, okay, how much have we paid off in principal? How much have we paid in interest expense? How much do we still owe on the loan? Okay, this is the calculator's way of doing it. You hit the equal the first time, it's giving you the principal. You hit equal the second time, it gives you the interest. You hit equal the third time, it gives you the balance. Okay, now, in terms of kind of what we were just talking about, in terms of this whole idea of kind of equity buildup, we've in essence added an additional $204,000 to our equity position. Does that make sense? Yes or no? Okay, so let's just sort of take a look. All right, our original equity was 20% or 200,000, right? Yes?
Yeah.
Okay, our equity buildup is another 204,543.27. So if we just were to stop there, then that would be what, 404,543.27, and because we're using a nice $1 million loan, then what we're really saying is
40%.
we now have 40.4% as our total equity. And the remaining 60%, in essence, is our remaining debt. Does that make sense, yes or no?
Yeah.
Okay,
You just subtracted that. You took
Yep.
200.
okay, does everybody understand what we just did? Okay.
The number.
Well, the principal, Professor.
Yeah, I think.
20,
I got 203, 543.
Yeah, me too.
27.
Okay, let's do it one more time.
This
It
is,
could be because of rounding.
I think you just go to the number.
Okay, we'll do it just one more time just to make sure. So 800,000, present value, 5% interest rate, 15 years as our term, solve for payment, 6326, 35, one input, 60, shift, amortize, equal 203, 540. Okay, I wrote it down wrong. My
Just,
bad.
yeah.
Methodology that counts.
All right, 203, 543, 27. Let's do it. 176, 037, 67, and 596, 456. All right, so
Represent 5 years.
change that. Thank you very much for catching that. All right, so that really changed too much. So 40.3%. All right. Are we good? Okay. Does everybody understand what we've done, why we've done what we've done?
No, what's the 403,000?
Okay, so what this is representing 5 years into this deal, what our equity position is, okay? We were at 200,000 or 20% of the total of the $1 million property because we were borrowing 80% or 800,000, all right? So what this means is after 5 years, we have paid off 203,000 of that loan. So that now is our money, okay? So whenever we go to, in essence, pay off the loan, all we really have to give the bank at this point is the 596,000, okay? We get to keep, obviously, the amount of equity buildup that we have achieved over that 5-year period, okay? Does that make sense?
And
So the total would be, the total amount of.
The total would be, this is your new equity position, okay? So you've gone from a property where you had 20% equity in the deal to now 5 years later, you have the equivalent of 40% equity in the deal,
Paid by your tenant.
paid by your tenant.
And the 60 just restaurant. 160 is just the payments that we made, 60 payments.
Yes, you made 60 payments, okay? So it's not, you know, like there's any real magic to it. It's just a lot of people don't really think about how important, you know, the idea is that your tenant really is paying your mortgage. I mean, it's a simple concept, but yet at the same time, you know, the effect of that over time, that, you know, 5 years into this, okay, yeah, I mean, you had a 20% investment, but you in essence doubled that by virtue of what the tenant has paid you, okay? All right, are we good? Okay, we're not done yet, but go ahead, yeah.
What determines if the interest is front-loaded on a loan? Like, 'cause we were messing with that.
Well, no, when you say front-loaded, are you saying that more interest is paid up front or less interest is paid up front?
Yeah,
Or
on the first payment, like the majority of your payment is.
the longer the loan term,
Okay.
that if your loan term is really long, you're going to have that much more upfront interest because you're paying on a larger dollar amount and it's taking longer to pay it down.
Okay.
Like we'll do a sidebar on that. Okay, real quick. Okay, so ignore everything we've just talked about for a second. And let's just say that we've got a $100,000 loan. And we do it with a, I don't know, let's just do a 10% interest rate, just so it's completely divorced from this previous problem. And we do for 30 years, and we do the payment, okay? Should be $877.57, let's just double check. Yep. Okay, so now if you sort of look at that and you say, all right, we're making that payment for how many months? 360, yes? Okay, so let's just take that times 360. It'll be a total of $315,925.77 in total payments. Now, if we were to change that to a 15-year term, solve for payment.
Wait, this is 100,000? It's on 7461.
Yep. Times 180 payments. Be $193,428.92. If we did it for, I don't know, let's just say a 5-year term.
So basically, you have to be charged interest payments for it to be extended that long, or else you just, it's impossible. Essentially.
Okay, all I want to show, just real quick, hold on. All right. So if you're comparing a 30-year loan to a 15-year loan to a 5-year loan, okay, $100,000 loan, and it's nice that it's 100,000 because it makes the math really easy. So what we're saying here is that with that 30-year loan, you're in essence paying what? $215,000 in interest. Okay, you just sort of subtract out the 100,000, the 215,000 in interest. With the 15-year loan, you're basically paying 93,000 in interest. And with the 5-year loan, you would only be paying 27,000 in interest, okay? So, you know, the point is that, yeah, with that 30-year mortgage, because you're paying down such a small piece of it over time, that you're obviously going to be paying the overwhelming majority in interest. And so it really is going to be truly front-loaded, you know, with a lot of interest expense, whereas with a 5-year loan, you know, it's going to be much more proportional to the dollar amount of the loan and the interest expense. Make sense? Okay. Thoughts, questions, observations on this?
On the first part, you're talking about equity build down, and then, but from my experience, it took a while for me to understand why. It's like a lot of the big commercial people will like just take 10-year interest only, and like is that just because it increases their cash flow for a certain amount of
Yes.
time? But then they don't get the equity.
I'm not going to argue that point.
Okay.
So the question is, you may have some people that instead of getting a traditional mortgage with, you know, traditional sort of principal and interest payments, they go exclusively for an interest-only mortgage, okay? If you go for an interest-only mortgage, you have no pay down, no equity buildup, you know, over that time period. You're gonna have higher cash flows, you know, while you are, you know, obviously owning that property in terms of the immediate cash flows, but you're not gonna get any of this equity buildup. So it's a question of a trade-off of, is there some, for them, potentially some sort of a tax advantage? Is, you know, the situation that maybe they never plan to refinance the property, or they never plan to sell the property? You know, there could be so many different possibilities as to what their exact motivation is for doing it one way or the other. You know, it really is, it's going to depend on what their unique circumstances are. Okay. All right. So are we comfortable with this? Okay. So now, let's say that the property itself that we bought for $1 million has gone up in value. Okay. And let's say that it's gone up in value to, I don't know, $1.3 million. Okay. So if it's gone up in value to 1.3, so let's just kind of sort of left there. Okay, so the property goes from 1 million to 1.3 million. So that means that we, in essence, have gained what?
300.
Another 300. So now we have 703,543.27 in equity. Now granted, this 300,000 is sort of phantom equity in the sense that we haven't cashed out of it. Does that make sense? Okay, so you know, if we don't sell the property, we don't get it. Or if we don't refinance the property, we don't get it. Now, what happens if after this 5-year period, this scenario has taken place, okay? That we've obviously paid down, you know, a good portion of the equity, we've achieved that equity buildup, the value of the property has also gone up by, you know, basically 30% from 1 million to 1.3 million. And now we're sort of sitting at a moment of saying, okay, what do we do? Do we sell the property? Do we keep the property? Or do we refinance the property? Okay, if we sell the property, we're going to incur capital gains. Okay, so that's going to be, you know, nice little tax hit we're going to take on the capital gains. Or, as we're going to talk about later, we're not going to confuse the issue right now, but we can do a 1031 exchange and sort of avoid that. Let's not bring that up right now. But if we choose to keep the property and refinance it, let's think about how that might manifest itself. All right? So, the property is now worth $1.3 million. We've had a market appraisal done. The bank is satisfied that it's worth $1.3 million. Okay? So, if the bank were to give us another 80% debt, 20% equity loan on this property, let's just see what that would be. Yep. Okay. So, let's think about what then we would have to do. Okay, first of all, let's take a look at kind of what has potentially taken place here. All right. We had originally put in $200,000 of our cash money. Yes? Okay. Now the question is, at this point, what's going to happen?
We're gonna get 260 back.
Okay. In essence, we're going to get $260,000 pretty much back at closing, or well, not quite, but sort of. That in essence, okay, let's take a look. The total is 1.3 million. Now, of that 1.3 million, what is going to be happening? All right.
We're gonna get our original 200 back, plus an increase in 60,000, which is in equity.
Okay. So, okay. One more time.
We're gonna get our original 200,000 of original equity, plus 60,000 of built-in equity that we've accumulated out of this refinance.
Okay. So that's what you're saying we're going to do.
Well, that's what the 80-20 split on the new value of the property is.
Okay.
Well, really, you're gonna get the debt out, right?
Okay. This is why I'm asking the question.
Yeah, you get.
Okay.
you get
So what are we walking away with, if anything, at the end of all
the
this?
1040, and then you're gonna pay back the old loan.
Because the 1040, we're going to have to, obviously, that is going to be the new debt that we're going to get. Okay. But in order to get that new debt, what are we, in essence, being able to sort of subtract out of this deal?
The old debt.
Okay. We've still got to, in essence,
Pay off the 543.
yep, okay. So let's just sort of try to take this one step at a time. All right. So assuming that we've kind of got the situation of the 1.3 million, what is now going to happen is, all right, let's take a look at that payoff. All right. What is the payoff that we had?
596, 456,
Okay, 596, 456.
73 cents.
Was that was the balance?
Yep.
Yeah.
Okay, so that was our debt payoff. All right. And also at the time of that debt payoff, what also was happening?
And we're not subtracting the debt from the new loan. We're
Okay.
subtracting from the value.
Well, do we need to?
What do you mean? What else is happening?
Well, okay,
I'm sorry, I didn't hear what she said.
okay. What we're trying to do is to trace the transaction. What is actually taking place at the time of the refinancing? Okay, so what we could say is this. All right, I'm trying to simplify it to where we don't screw it up. All right. So what we do, we're going to pay off the 596, 456, right?
Yeah.
What you actually get?
Okay, so we assume that maybe this refinancing, just to keep things simple, is with a new lender. Okay, that'll help maybe clarify so we don't get messy with the details of what's happening internally with the existing lender. So we pay off basically the existing lender that amount. All right, so assuming that we were just sort of selling the property, let's kind of use that mindset for a second. If we pay off that, then what do we have left over? Okay, we're getting, in essence, it's one way to sort of look at it, if the value is now 1.3 and we pay off the old lender, the 596, what are we left with?
700.
Okay. $703,544, and we're obviously rounding, so this is sort of the leftover.
That was our original equity.
Right.
Yeah.
Okay, so that's what we're sort of left over with now to go into this deal with the new lender, yes? Okay, so we go in to this new lender and we say, all right, we have this property that is worth 1.3 million. We have cash available of 703,000, yes? Okay, so the lender says, okay, yeah, I'm willing to give you basically a loan for 1,040,000, yes? Okay, so we take that. And, which is gonna be 80% of the total. And then they say, all right, in order to do that, we obviously want you to, in essence, contribute 20% or 260 into that deal. For the total of the 1.3 million. Okay, now, this 260 is going to come out of our what?
Leftover.
That leftover.
cash.
Okay, so we're basically going to say 703,000 minus the 260.
443, 5,
All right, so this would be then the dollar amount on a before-tax basis that we would, in essence, it shouldn't be taxable because, once again, we're refinancing the property, okay? So this would be the amount that supposedly we would walk away with. Okay, does that make sense to people, yes or no? Now, if you think about it, in one sense, 300,000 of this was just simply the price appreciation, okay? But 143,000 of it was due to basically the equity buildup, but also keep in mind, what are we actually doing? We're getting a larger loan, okay, than we were before. Before we only had an $800,000 loan, now we have $1 million loan, okay, because the property is worth more. But the beauty of this, and this is the part that is critical for you to understand, is this amount is technically tax-free. You understand that? Because there's no capital gain. You didn't sell the property. I mean, yes, we sort of talked about that you know, we were trying to think of it as if we're selling it, but this is really just to do the calculations from the perspective of, you know, what sort of gain did we have with respect to calculating what sort of a loan are we going to get, okay? Does that make sense?
So you're just interested in the refi proceeds.
Right. Or, another way of, you know, sort of looking at it, I mean, you could also sort of say, well, how much in total equity did we build up over this time period, which would have been,
43.
well, the total equity that we would have built up, just the equity buildup would have been this, but the total equity, if we include basically the price appreciation, would have been the 703,000. Okay, does that make sense?
Question.
Yep.
Is it purely coincidence that if you take the new the, old debt and get the same number for the closing?
That's how you should do it, that's like the easy way.
There's more than one way to approach it. I was trying to approach it in a way that, at least in my mind, would make that much more sense to a person. Okay? There are shortcuts to doing it, but sometimes, you know, just thinking through as if it was two separate transactions might be the easiest way to kind of conceptualize it.
Okay, but again, it's only like that one kind of works a little bit easier in my mind because that value of the 1.3 million, that's not like, that's just the value of the property, that's not like tangible, like an actual number that you owe. It's just saying your property has increased in value, but it's not like money in hand.
It isn't, but at the same time, it's also, it's a way to, I don't know, just to get some sort of a feeling of what is that dollar amount that I have really achieved from the owning this property. Because in one sense, you don't really get to realize it until, as I said, the property is sold or refinanced. And you're not really, and this is the part that makes, in my mind, it makes it a little bit complicated, a little bit confusing, is we're kind of conflating a couple of different things because the whole idea behind the refinancing of this is not to refinance it just for the sake of refinancing. The reason we're refinancing it is it allows us to rip out a significant amount of the equity gain that we have achieved in this property that we can then use this money. We're not going to like take it out and spend it necessarily. We could because it's tax-free. But what we can do is take this money, plow it into another investment if we choose to, and kind of rinse and repeat. This is how you, in essence, build up an empire, you know, to a certain extent, is that you're constantly figuring out a way to buy, obviously, properties at maybe distressed levels. Over time, you know, you have the equity build up from the mortgages being paid, but then allow you to refinance and then take those proceeds, buy another property, rinse and repeat, do the same thing, you know, and keep doing this. Now, it works all wonderfully well, unless all of a sudden the tenant or tenants in these properties, if they're obviously not owner occupied, the tenants in the property aren't paying their rent or paying less than rent. Now see, you know, because also part of the assumption here, this is also another thing you've got to kind of think about. Yes, the market has said this property has gone up in value from $1 million to 1.3 million. But if you're still charging your tenants rent based on the $1 million, you're probably not getting much of a return and, you know, off the property. In other words, more than likely you may have to raise your rents in order to afford that refinance. Because the lender is still going to be applying the terms of what is the debt service coverage ratio. Okay, this just makes the assumption that they're applying really much only the loan to value ratio as a criteria for making you the loan. This is sort of ignoring what the underlying fundamentals are in the property that would have supposedly given it that full $1.3 million, you know, in value. You've really got to almost, it's not necessarily that you're going to have to raise your rents by 30% to achieve this, because there are many other sort of factors that may influence the kind of the leverage that you're achieving in the property. That it may only be you have to raise rents 5 or 10% to ultimately have that flow-through effect of the value increasing that much.
Are the underwriters going to assess your property based on like a market set cap rate?
More than likely.
Okay. They're just gonna see what others trade for at
Right.
retail, and then, okay.
But they're still fundamentally gonna, just, okay, let me try to put it to you another way. We've got two identical, let's say, apartment buildings, okay? There's no difference between the two of them, both built at the same time, same builder, everything's identical about them, next door to each other, and you own one, and you know, you bought it for $1 million, and now, you know, you're basically saying, well, it's worth 1.3. But your neighbor maybe has just bought theirs for 1.3, all right? They're gonna come in, they're gonna assess whatever rents they feel like are necessary in order to please their lender, all right, you're over here trying to refinance your property. Chances are, you know, you're going to have to raise your rents in order to satisfy the lender as well.
Yeah.
Okay, it's not necessarily going to be the case that you're just going to be able to keep your rents where they are, you know, after going through this refinancing process.
It's based on income.
Right. Now, what you could do, and it may, you know, generate some value, is that, yeah, if you've paid down a very significant portion of the building, and in other words, through equity buildup, that you may say, all right, well, maybe what I want to do is just simply cash out some of that equity that I've paid in. In other words, it's almost like getting a home equity loan in that sense. That, you know, over a period of time, you have paid off the property, you know, a very significant piece of the property, and now you're all of a sudden saying, okay, I've got all this built up equity, but it's going nowhere, it's benefiting me in no way other than, yeah, I've got more net wealth, but I can't really access it unless I borrow it. Mm-hmm. Or, you follow what I'm saying?
No, 100%.
Okay. All right. Question? Yep.
Yeah, how is the growth treated accounting-wise? Because if you have the original property at 1 million and you're already depreciating it, how would you come back and restart the schedule on 1.3?
No, you would not. And that's an excellent question, because you're not selling it.
What was his question?
About the depreciation.
Would you
Because
restart the
there's no
schedule?
sale that has occurred. Just
Right.
because you refinance the property, refinancing is independent and divorced from tax depreciation.
So how would you depreciate the 300?
You don't.
So you just taking in
You basically are stuck with that original amount that you purchased it for.
at the 1 million?
Because you're the original owner.
It's tax-free though, so you wouldn't need to depreciate it, right?
Right. But I understand where your question's coming from. The point is, the depreciation clock only resets whenever you sell the property.
Arm's length.
Yep. Now, if in the midst of this refinancing, okay, let's say that you sell it from yourself to some sort of a corporate entity that you may be somehow affiliated with, chances are, yes, you can restart the depreciation clock with that higher dollar amount. Okay? Does that make sense?
Yeah. So
But if you're still the owner, nothing has changed in terms of, you know, it is, you know, still Kenny Cedino on the ownership of the property in the refinancing. There's no sales transactions taking place.
Okay.
Now, another little, not to try to make this more complicated than what it needs to be, this is one of the reasons why also that a corporate form of ownership in some way can be very, you know, it can add some additional benefits, because what constitutes a sale? Well, what constitutes a sale in the eyes of the government is whenever you transfer from one ownership entity into another ownership entity.
Just a different
You
thing.
buying and selling shares, you know, like for example, let's say that I start up a real estate investment trust, okay, and I have 100 shares to be able to, you know, sell off in that investment trust. I currently own 100% of those shares, okay, all 100 shares. But then I say to you, I'm going to sell you a share, I'm going to sell you a share, I'm going to sell you 2 shares, I'm going to sell you 3 shares, you know, and get rid of all my shares. Has a sale occurred? No. Not from the eyes of the government, because that is, the ownership entity is still the real estate investment trust. All I have done is simply sell off my, now, do I have a sale for me personally that I've got to, you know, address? Yes, because I personally will have either a fractional interest or a full interest of the sale of the securities that I sold and a capital gain associated with those. Does that make sense?
Yeah.
But in terms of the entity itself, the entity has not changed, therefore the depreciation clock has not changed.
Okay.
Okay? Thoughts, questions, observations? Okay. I guess do at least one question. Okay. On the quiz.
That's one.
That's one. Okay. There it is.
1 and 3. That's one.
Yeah, actually, it covered 1 and 3. What the heck? Yeah. We kind of killed 2 birds with 1 stone on that one. All right. So accumulated depreciation. Okay, totally separate, divorced topic in the sense of want to keep everything kind of separate for purposes of the quiz, but also just because I don't want to complicate things. All right. Accumulated depreciation is what? Somebody give me like a 1-sentence definition.
Depreciation that you've already taken.
Okay, depreciation that you have taken on a property. It's a simple, straightforward explanation. You've owned the property for several years. Over that ownership period, you have taken that tax deduction of depreciation each of those years. Yes? Now, at the time of sale, not refinance, but at the time of sale, you then have to account for that accumulated depreciation. Okay, that's where this is different than the refinance kind of thing. Okay, with accumulated depreciation at the time of sale, you actually get taxed on what is now called your recaptured depreciation. All right, which is in essence just another word for the accumulated depreciation. All right, but it gets recaptured in essence, sort of that you are selling the property. And you're selling the property for more than its depreciable value, therefore you are sort of reclaiming that depreciation, and as such, you then now have to pay income tax on that reclaimed depreciation or recaptured depreciation. Does that make sense conceptually? Yes or no? Okay, because you've been receiving this tax benefit for several years. Okay, so give me, let's just start out with another example. Give me the dollar amount for the property. You're gonna go with $1 million again just for fun? Okay, it always keeps it simple, just from calculation perspective. Okay, so we have $1 million property, but here we're not talking about loan amounts, we're talking about the depreciable basis of the property. So what we're talking about here is, all right, if this is the total value of the property, then how much of it is going to be land value, and how much of it is going to be improvements value. Now, we talked about this a few weeks ago in terms of, you know, the different ways that you sort of come up with that and that sort of thing. So give me either a percentage or a dollar amount for the land value.
90 cents.
Okay, so well, let's do something other than 20/80 since we kind of did that on the previous thing and I don't want people to confuse it. So you do 30/70?
Yeah.
Is that okay? All right. So basically, 300,000 is our land value, meaning that our improvements value would be the remaining 700,000. Okay? Everybody good? Now, keep in mind we've got at least 2 different primary depreciation terms that we have to be aware of. One is for residential property, the other is for commercial property. Okay, residential property, what is that depreciation term? How many years? 27.5 years.
I was guessing.
And commercial was
39.
39. All right, so what do we want this property to be? Residential or commercial?
Commercial.
Okay. All right, so if it's commercial, we're going to apply the 39 years. So in this case, we're going to take this 700,000, divide it by 39 years in order to get our annual depreciation.
It's only based on improvements?
Yes.
Really?
That's what we did, trust me, 3 weeks ago, 3 or 4 weeks ago.
Yeah.
Will everybody confirm that for me?
Yes.
Yes. Okay. Depreciation is only based on the improvements value because you don't depreciate land. All right? So 700,000
17,94872. How many years though?
Well, in this case, we're just getting the initial
Okay.
annual number. Okay, so 17,
94872.
okay. And that would be our annual depreciation. Now, how many years are we going to hold this? 10. Okay, we're going to have a 10-year holding period. And for the purpose of your quiz, I actually say to ignore the whole mid-month convention thing, just to keep things simple. And just simply say you've got a certain holding period. In this case, we're going to say 10 years. All right? So all you're going to do is take this number, the 17,948.72, and do what?
Multiply that times 10.
Multiply by 10.
So it's 179,487.
Okay. So this is, okay, that's for 10 years. This number represents your accumulated depreciation, okay? But we're not done yet, okay? But that number is what represents our accumulated. In other words, that is the amount that we have written off as a depreciation expense for, in essence, each of the 10 years, okay? Does that make sense? Everybody comfortable with that? Okay, so whenever we go to sell the property, we are going to incur a tax on this amount. Does that make sense? If we sell it for more than, you know, it's a, like for example, if we sell it for pretty much anything, you know, more than $100,000, we're going to have to pay the tax on that if we sell it. Okay? All right? And I'm sorry, if we sell it for more than $1 million.
Okay.
Brain fart. Okay. All right. If we sell it for more than $1 million, we're going to have to pay then the accumulated depreciation or pay tax on the accumulated depreciation. So in this case, we're going to make the assumption of a 21% tax rate, which is apparently the recapture depreciation tax rate currently.
And does your accountant just like figure out the value of your property and
Yes.
do it however he sees fit, or
Pretty much.
or do you have to get an appraisal done and it's according to that?
Everything is, I'm trying to think of the right words to use. You can put whatever you want to put on your tax forms, but you're going to have to justify it. The question is, what are you going to use to justify it in the event that you get called on the carpet for whatever you've chosen to put, okay? So my advice is, yeah, you probably want some sort of third-party independent appraisal done on the property to say, okay, well, this is, you know, what it's worth. Okay. All right, so multiplying that by 21%,
What's 21%?
this is our recaptured depreciation tax rate. So 37,692.31 would be the taxes payable. It's income taxes payable for recaptured depreciation. Okay? Now this is only if you sell the property. Okay? If you don't sell the property, none of this takes place. This is why there are, you know, a good significant number of people that choose to never sell their properties. Because then they never have to worry about paying this, they never have to worry about trying to defer it with some other sort of mechanism like a 1031 exchange. And so, but if you do choose to sell the property, you're going to pay this at a minimum in terms of the sale, but you're also going to then have to pay whatever dollar amount you sell the property for above the $1 million in capital gains tax. So if you were to sell the property, let's say for $1.2 million, then you would have a $200,000 capital gain that you would then have to pay capital gains tax on, in addition to the recapture depreciation tax. Does that make sense? Okay? And everything is a little bit of a different, you know, sort of tax rate. Because, let's see, yeah, the long-term capital gains tax rate, 15%. So it's kind of interesting. Once again, tax law, as I told you guys, you know, a few weeks ago, tax law is not the real world. Tax law is a tax world. And so you have one tax rate of 21% on recapture depreciation, but for capital gain, if you sell it for more than this, the tax rate on a long-term capital gain is only 15%. So it's like two different tax rates applied to the same sale, but two different parts of the sale. Okay? And you're going to say, why? Well, because Congress said so. Okay?
Would the same tax rate apply to the residential, or would that be a different tax rate as well?
In that component, they're the same.
So,
The only thing that's different would be the depreciation term.
Okay, so the rate.
The rate is going to be the same, but the dollar amount that you're going to be recapturing and accumulating is going to be different. Because if you think about it, this, if it was 27 and a half years, then the dollar amount that you're going to be depreciating each year is going to be a bigger number, meaning this is going to be a bigger number, meaning you're going to have more tax that you're going to have to recapture. Okay? Because in essence, you're getting a bigger benefit while you own it if it's residential. Okay? Now, part of the logic, if there is logic, on this recapture depreciation, while you own the property, you are obviously paying income tax on whatever the operating income of the property is. In other words, you know, you're collecting rents, you paid your mortgage, you paid your operating expenses, you got money left over at the end of the day, that money gets taxed. Okay, but that gets taxed at ordinary income tax rate, which is, if you're an individual and you own it, then it's your marginal tax rate. You know, if it's a corporation, then it's at whatever corporate tax rate, you know, is. If it's a flow-through entity like a limited liability company or S corp or something like that, they don't get taxed at the corporate level. All of it flows through to the individual. But you know, so in other words, think about it like this: you get at least a minimum of 3 different tax rates, 3 different types of taxes that are sort of coming and going off of the ownership of real estate. So it's not just an easy peasy kind of thing of that each one is taxed at the exact same level, and they're, you know, this is why that it does help to sort of model this out and sort of, and in some cases say, depending on who is the owner, whether it's a corporate entity, whether it's a pass-through entity, whether it's an individual, whether it's a partnership, all of those have different tax implications to where, in one sense, depending on that ownership structure, it may be advantageous to never sell the property, or it could be advantageous to sell it relatively quick, or to try to push more things, you know, into a capital gain as opposed to, you know, declaring them repairs and maintenance. So I mean, there's all these different things, but that's why you have to model it out to really see what the implications are, to put all the pieces together. Yep.
Is improvements value the same thing as building value?
Yes.
Term? Okay.
Yes.
And that's, going back to your original comment, and that's more critical when you come into a combination. So like the parent entity will be an LLC, but individually, they can be different.
Yes.
Structures.
Yep. This is the part, you know, I'll do a quick little sidebar and get back into this, but this is one of those things that has always personally kind of frustrated me, because it's like, why do we have to have such a complex Byzantine tax structure? To where, no, and I'm serious whenever I say that, because it's like sales tax is easy. You go buy something, you pay a %, you're done. You know, but whenever it comes to income taxes, you know, whether it's off of real estate, whether it's off of your, you know, personal income, you know, and wages and that sort of thing, everything gets very complicated very quickly, you know, in terms of, okay, standardized deductions versus itemized deductions. Okay, well, do I live in a high tax state, a low tax, you know, all these other things. And yet, what we end up having to do to deal with that is the part that really frustrates me. We have to create entire degree programs focused on taxation, that you can get a master's in taxation, you know, because the system is so ridiculously overcomplicated. But yet, having just said that, the people who take the time to understand it can potentially benefit from it in amazing ways, because they can always find that unusual, you know, loophole or unicorn circumstance that allows them to really profit and benefit from that true, deep understanding of the tax law.
Yeah, there's a very small pool of people that actually.
Right, because most people probably end up, well, either they overpay, which is probably my category, because I don't.
I'm disappointed, sir.
No, but because a lot of times I just don't want to push the envelope on
Yeah.
those sorts of things, because I don't want to go through the brain. I've watched people go through the brain damage of being audited. It's not pretty, okay? You know, you never want to be audited, okay? Because it is not a pretty sight. And, you know, even if you've got really good records, you know, they're going to almost always find something. And so, but you either have a person that overpays, or you're going to have the people that are maybe trying to cheat the system in some way, and then maybe eventually they get caught, and it's not going to be a pretty sight. So, I don't know, I just would much prefer a simpler, more transparent, easier to understand tax system, but unfortunately that's not the world we live in. You know, we live in a very complicated sort of arena. Okay, moving forward. Okay, like-kind exchange. So this gets us into yet another one of those quirky deals. Okay. Very simply put, the like-kind exchange is also referred to as a tax-deferred exchange. People in many cases will call it a tax-free exchange, and it's really not accurate. Yes, you're getting off the hook right now for the income tax, but you're going to eventually have to pay the income tax at some point, you know, in this sort of circumstance of the like-kind exchange. What it basically boils down to is this. The IRS, well, Congress specifically, but the IRS is obviously the enforcement mechanism, you know, set up this, what is in the code of section 1031 of the Internal Revenue Code. That's why it's called a 1031 exchange. It just happens to be section 1031 of the Internal Revenue Code. And it deals with this whole thing of a like-kind exchange. And the thought process kind of originally behind this was, okay, we understand people are going to be buying property, they're going to be buying businesses, and, you know, let's say that, you know, you're not even necessarily even in the real estate business. Maybe you're just a business operating, I don't know, a manufacturing facility. You own the manufacturing facility, all right? So you have bought and you've owned this manufacturing facility, but you outgrow the manufacturing facility. You need to buy a new manufacturing facility, all right? Well, that sort of transaction should, and the idea was, we don't want to tax somebody on the sale of that original facility before they go buy a new facility, because if we do, in essence, that takes money out of circulation in the economy, and basically it's, you know, in one sense, hurting that person, you know, by making that sale before they can basically make the new purchase in a new upgraded facility, whatever that might be. So the thought was that, okay, let's create this mechanism to where that if you do sort of up trade in property, that you in essence can do so without having to pay capital gains tax, okay? But it pretty much, the predication is that you've got to go from a lesser value property to either an equal or greater value property in order for it not to be taxed. If you basically take $1 million property and you sell it, and you buy a $500,000 property, then you're probably going to have to pay, you are going to have to pay a capital gains tax, you know, because you have bought a lesser value property, okay? Does that make sense? Okay. Now, here's what has happened, without getting into all the nitty-gritty details, is that the rules that have been established for this have been tightened up considerably over time. It used to pretty much be the case that, okay, you know, you're selling your office building, you're buying a new office building or an apartment complex or whatever. You've got, you know, a pretty significant amount of time to be able to identify what that new property is going to be, and you can even, you know, identify a ridiculous, almost infinite number of possibilities of that new property that you're going to buy, and you know, it was fairly loose, okay? Well, over time, the IRS was like, yeah, we probably need to tighten this up, you know, and so they have gotten now down to the point where you have a very limited time to, number one, you know, identify you're going to do a tax deferred exchange or a 1031 exchange. You've got a very limited time to identify the new property that you're going to purchase. And if you don't end up going through that transaction and you don't find a new property, you're going to get stuck with that capital gains tax, okay? So they've made it difficult on purpose because now they're going to start collecting that much more in income tax off of these sales for people who don't go through the process in a very mechanized way. And so what is actually created, and this is, you know, kind of an interesting thing in and of itself, is there's a whole cottage industry of basically 1031 specialists, okay? But if you hop on, you know, the internet and just, you know, type away 1031 exchange, you know, specialist, all these people do are these 1031 exchanges. They are the intermediary. Because, and you're saying, well, why do you need an intermediary? Well, because of, once again, the way in which the tax code is written, that, like, for example, you sell your building for $1 million, or maybe, you know, a couple $100,000 of that was a capital gain. If you take possession of that money in your bank account, you're going to pay capital gains on it. But if you transfer, or you, whenever that property sells, it never touches your hands, and it goes to Alex, who's a 1031 intermediary, and it hits his account. He is just sort of holding that money kind of in a you know, a savings account for your benefit, but you can't touch it. Does that make sense?
He's making interest on my money?
It may or may not be, you know, but the point being is, yeah, he has your money, okay, and then at some point, whenever you go to buy his property, then all of a sudden, you're going to have to make them a transfer, you know, to him, and, you know, you're not part of it, okay? Does that make sense?
Actually, does that also take an effect? So like say I sell the property as a 1031 exchange. The guy wrote me a check, or the bank wrote me a check. If I have that check in my hand, does that still qualify, or does it qualify when I deposit that check in my bank account? Because I have the check in my hand.
My understanding is it would qualify whenever it hits your bank account.
Okay, so
But if it's cash, if it's a check and you have not cashed it, it would have to be, I think you immediately would sign it over to the 1031 intermediary.
So there has to be mandatory intermediary. It's not like a 401k where
No, there's got to be, I mean, the only way to avoid any sort of scrutiny from the IRS, or to limit the amount of scrutiny from the IRS, would be to make sure that you have the intermediary in place at the time you sell the property.
Do they help you find property or no?
They can, but that is sometimes not really their job. Their job is really more for, you know, just processing all of the appropriate paperwork with the IRS to make sure you're meeting all the deadlines and telling you, all right, Cole, you've got to get out there. You've got 60 days to identify the property that you want to purchase, and so many days, and after that to close on the property and
Isn't
so
it 6 months?
whatever the time frame
But
is.
you can just identify before you sell.
You can, but it's not, I'm not trying to belabor the process. What I'm trying to say is the process, and I'm not even really overly concerned with the process. What I'm concerned with is more of you understanding there is a process that you probably need to use an intermediary in order to keep the transaction clean, and the benefit of doing this is to defer that income tax, that capital gains income tax, for as far into the future as you possibly can.
And so the income tax that you're paying on the cash flow gets offset by the depreciation?
Well, in this case, you're not going to be taxed on the depreciation either, because technically it's a like-kind exchange.
Well, that's what I'm saying. So so let's say that you plan on doing the 1031 and you're just going to roll it and not pay capital gains.
Right.
But you said that you are getting taxed on cash flow.
You're always going to be taxed on cash flow, yes.
But that's offset by your depreciation, so technically you could pay no tax. Because then, like, because you're not going to recapture any of the depreciation, you're just going to roll it into the 1031.
Yeah.
And so then where are you paying tax?
You're not. That's the whole idea.
But like on anything, on any part of it.
Well, but that is the whole idea, that it's simply, the way the IRS is looking at it is you are simply transferring, that's why it's called an exchange, is you're simply transferring from A to B.
No, I get that.
You know, and so it's kind of like A no longer exists, now you own B, and we're not going to charge you any taxes to get there.
But as a landlord, if your goal is to keep 1031, keep rolling your money so you keep deferring your tax, while you're collecting income, while you own the property, you're paying income tax on the cash flow.
Yes, you are.
But you can offset that by the depreciation.
You could.
To not pay tax on that.
And that's a possibility. And that one, I want to stay away from that, because that might be, once again, that's more of a CPA question.
Okay. And then I was going to say after that, and then after you use all your depreciation, then you can 1031 into the new one, and then like essentially your tax liability is zero.
Yeah. Once again, I'm not going to go down the rabbit hole on that one.
Okay.
I understand where you're coming from, but I'm afraid on that one, I don't know if I want to touch that one. Okay. Now, so in this case, I'm trying to see if we can back up. We got a little bit off track there. All right. Okay. So, how much did we originally buy A for? Give me a dollar amount.
10 million.
Okay, we bought it for 10 million. How much did we, in essence, sell it for? Or what was its value at the time of where we're going to do the exchange?
12.
Okay, so that would represent basically a $2 million capital gain. Okay, now, so let's say that we roll that into property B, and property B's purchase price is 15 million. So that means that we're basically taking the 12 million from here, putting it toward this, and then that means we've got to come up with, in essence, $3 million of equity or cash. But we defer any sort of tax on the $2 million gain. Does that make sense? Now, in this case, let's assume tax rate for capital gain, I think it's 15%. So by doing the like-kind exchange, the 1031 exchange, we would not be subject to the 15% capital gains tax, which would result in $300,000 in taxes. Okay? Does that make sense?
So you have to come out of pocket $1 million?
So, in this case, all right, let's make sure that we're clear. I don't want to conflate things here. All right. We bought a $10 million. We're not going to get hung up. Let's just say it's an all-cash deal, just for the simplistic purposes of our example. We bought it for $10 million. We in essence sold it for $12 million. If that would have represented then a $2 million capital gain, that if we had just simply stopped right there, not done anything else in terms of a like-kind exchange, we would have been subject to a $300,000 tax on that gain. Okay, is everybody with me? Yes or no? Okay. But because we took the sale proceeds, the total $12 million, we plow them into property B. Property B, the purchase price for it was $15 million, so it's worth more. We've got $12 million coming to us from the sale here. That means that we've got to come out of pocket or pay cash or additional equity of $3 million, or a loan, whatever it takes to get to satisfy that. That doesn't inherently really matter. But the point being is we've got to come with $3 million. Now, if we had treated these as two completely divorced transactions, we would really be having, in one sense, we would have an additional $300,000 of expenses associated with the transaction of just going from A to B. But we're avoiding that $300,000 of transaction because we are using the like-kind exchange. That's the lesson, okay? Make sense? Now, if it's a small property, and this is I have seen people that have done 1031 exchanges on, $100,000, $200,000 properties, and I just like, why? Because, they're the tax savings or whatever, because in many cases to do a 1031 exchange, it's several $1,000s. I mean, it's not like it's a free transaction to actually do the because the people like Alec that maybe are doing a 1030, that's his business, he's going to make an income. So it's not like, he's just sitting there and, not charging you anything to do this. So it's, a few $1,000s at minimum to potentially do a 1031 exchange. So obviously your tax liability has to be large enough to substantiate it, is what I'm saying. Okay? Plus all the brain damage of going through the process. Okay? All right?
So you need to come out of pocket $1 million for this one?
I'm sorry?
You need to come out of pocket $1 million, you need to bring $1 million to the table.
No, because we're saying this is the capital gain. We're putting the full $12 million into the $15 million, so that's why you're going to come up with $3 million out of pocket. Okay, because it's a more expensive property that you're buying.
What's the opposite way around, like for them? Do they have to pay any taxes on the $3 million?
Okay, that's what I was just saying. That if you had separated this and we did not do the like-kind exchange, you would be subject to a $300,000 tax. Then, if you did this, okay, yeah, you would have bought it for $15 million. You would use the $12 million from here, and you would have come up with $300,000 cash. But you would also have to pay now $300,000 extra in taxes.
That's assuming no debt.
Right. I purposely kept it without debt.
Yeah, that makes it more confusing.
Okay. All right. Questions? Yep. Kenny.
In your example, you're basing it on the property, right? In the book's example, they based it on the property value. What constitutes a like exchange? Like, what is it that triggers like a similar property? Because I've also seen people talk about 1031s where they're going from one property to a different type of property.
Oh yeah.
But what constitutes a like
income producing?
But Xing that, because we're all talking about investors, we're not talking about personal residences.
Right. Yeah. This is not applicable to personal residence.
Income producing. But what actually constitutes a like exchange? What is a similar property?
Like for example, most of the time, my understanding is that you would not be able to, let's say, do an office building for raw land that's non-income producing.
That's not qualified.
My understanding is that it would not be. Now, if that raw land is income producing in some way, then I don't know. you're running cattle on it, you're growing crops, and there's income being generated off of it. It's now an income producing property, therefore it potentially could be tradable.
What if I'm a developer and raw land is my commodity?
Well, if it's sort of raw land for raw land, then that's potentially,
But no, raw land, all right, so I built up an office building, I sold it, I want to do a 1031 exchange for another raw land so I can build something else.
and that's where it gets really complicated.
Oh, good God.
Well, and
Because it's not, then it's no longer really, truly a like kind exchange.
But
And I understand what you're saying, and this was not put into place to make developers money. Okay, you know, because I understand what you're saying, because what you're suggesting is, okay, this is a perfect mechanism for me to be a developer and just constantly roll from one deal. And that's not what it's meant for. It's meant really for, once again, income producing property to another income producing property.
But if I'm a developer, raw land is my commodity.
I understand what you're saying, but it's not income producing. Raw land is not income producing unless it's income producing. Okay.
I don't think the raw land is gonna be.
What I call raw land is raw land that's sitting out there in the middle of nowhere. It has not got cattle on it. It has not got crops on it. It is not being used in any way, shape, or fashion by anyone for any purpose. That is raw land. Okay? And therefore, you would not be able to trade an office building for that raw land. My understanding.
So it has to be producing income at the time.
That is
In
my,
the future.
that is my understanding.
Well, and you also said that it has to be the same amount or more, right? It can't
Right,
be-
well,
it can't
in
be
the
less,
sense
so
of-
your raw land is probably gonna be less than what you sold.
Well, no, it's the dollar amount of the purchase price. It's not the income it's producing.
Right.
Yeah, the income that it's producing could be less,
Yeah.
but it's a dollar value.
Right.
And once again, I don't want to get hung up on the intricate semantics of what can or can't be specifically done. What I will say is you can do an office building for a retail center. You can do a retail center for an apartment building. You can do an apartment building for a movie theater. You can, all of that is perfectly acceptable. And I would argue that the majority of 1031 exchanges are really, truly like kind. That it really is an office building for an office building, an apartment building for an apartment building. It doesn't have to be that constricted, but most of them really are.
And then also, in the book, they explain how, something about you can't sell shares out of it. Can you elaborate on that?
Well, this gets back to what I was sort of talking about earlier with if it's set up as a real estate investment trust, then if you were to initiate a 1031 exchange, it makes it really complicated and convoluted as to then the timing and sequencing of, like, if you're buying and selling shares while that's going on, like a right before or right after it goes on, it begins to just exacerbate the tax complications of it. Okay? And so I don't know the exact language of how that piece of it, is sort of written, but my understanding of it would be that, yeah, you're not going to be able to play some silly game over here of setting it up as a corporate entity and then go through this 1031 exchange and somehow create some sort of tax dodge. Okay? Yep.
Well, let's make sure to understand. You said that you will come up with the 3 million cash equity. In this case, you pay the 300,000. Is it still in example B? You still have to pay the 300,000.
Not if it's a like. If you go through with the like kind exchange and it's accepted by the IRS, you don't pay that.
You don't pay that. That's okay.
Right.
Ooh, and last,
But that's also the thing is the IRS has to accept this.
Yeah.
Okay, if they reject it, you're paying the 300,000. So that's the downside of this. You could go through this whole process, and the IRS gets you on a technicality of saying you did not do X, Y, or Z as it relates to fulfilling the precise regimented details on, because, okay, you know, it's sort of funny, but you know how regimented San Miguel is about his deadlines? Okay? And I would say this to his face, because I'm saying on you know, text, I love him to death, but he is the epitome of how the IRS looks at things, okay? A deadline is a deadline is a deadline. And the IRS treats it very much the same way. That like with a 1031 exchange, if they have given you 60 days to perform a specific transaction as it relates to that 1031 exchange, if it occurs on the 61st day, null and void. Okay? That's what I'm saying. The consequences are there for explicit, you know, following those rules. So the instance of you not following one of those rules, that's your penalty.
Harsh.
And just to mention, it's actually, you have 45 days to designate those properties and 180 from that day to actually close the property.
Right. And once again, that all changes over time. I mean, you know, every so often, Congress, you know, decides, okay, we need to, or you know, the IRS maybe initiates some sort of movement within Congress. But at the end of the day, they say, okay, we're going to revise these rules, and so next year the rules could be different. Okay.
The depreciation clock on the new purchase starts again as well too?
Because it is a purchase.
On the new dollar amount as well?
That is my understanding, yes. Okay, can we move forward? All right. So, okay, that takes us through basically questions 1 through 4. All right, now, let's do this. Let's take about a 5-10 minute break, come back at 9:30. If there's breakfast left over upstairs on the 3rd floor, feel welcome to go get some food. Come back and we'll start at 9:30 on the basic deal structure stuff.
There's this house I'm trying to buy now, hopefully today. I'm gonna do.
Yeah, so Tony Charlotte is going to be our mentor. I need to send you, to talk to him about, we had a board meeting on Thursday, so basically I just need to send the packet to you and to him and just say, okay, make time. How much are you going to have to pay in taxes? How much would you save in taxes? Oh, I'm sorry. Oh, well, how much like equity do you basically need? It depends on what I ask. Correct. I could ask for both. I could ask for either one separately.
So you take that, 1.3, right? And then you take out an equity, which is 4.3. Plus you have the appraised value of 300. So sticking with the same equity structure, 81. Equity of 260. Pay all of the balance. If the property appreciates, you plus what you
Combine question. What you're going to out of pocket.
Yeah.
Also, the refund of the question be a combination of this and this.
It would just be like, what would be the benefit of the refinancing? What would be the savings? What would be the amount you pull out of equity?
Yeah, pretty much.
Just basically used to be what
So like what you're gonna get out of pocket, that you don't have any taxes.
Yeah.
Yeah, because you
Right. More than likely, yes. I mean, it's yes.
Then you go one, input, so we split that 60, shift one, and then you get the balance.
So yeah, so this is like monthly, right? This is the debt that you take. What is the 5 that's for interest rate? And then this is the assumed loan here. This 3 times. The last one. This is
Hey, viste, ganamos la serie del Caribe, ahora me FIFA los béisbol.
No, I don't watch the baseball.
I don't watch baseball either, I'm not that big, but the Dominican Republic won the
The World
series.
Series?
Yeah, the champion for the Caribbean tournament, whatever it's called.
Jesus Christ. I haven't watched it in a while. Years.
So, then to do holding period, you just divide it. So you multiply for the 10 years.
You know, I got I get the South Florida Business Journal as well too, and I get it for New York. New York just changed the rule on the brokers' compensation, where now brokers are getting paid by the landlord, and there's a big uproar because it's shifting the dynamic.
Interesting.
Yeah, there's a lot of people reading that new tax law, and they're finding that it's only for new properties, not old properties also.
How did you study for the law class? I used the online textbook, so I just read it. It was simple. So. Yeah, it was simple. Yeah, foreign investment, real property tax. Yeah, that's the as-is contract. So there's no guarantees made for any student. Like chain of title and will show up previous one.
It depends on you. Do you have computer software easy or not? It depends
It's
on the
just like over
average.
10,000 you have to report.
Like we can't pick up software easy, I just have to
Certified check, they have a certain.
what it's doing. But
It's like,
like maybe the GIS, that one took me longer to
Boot is the amount left
I
over.
understand
Sale of the
what
joint
money is done. I didn't know.
Single member LLC that's taxed as just individual, individual one member.
I'll take it eventually.
So, liquidated damages, that's.
Anything you do here for the company is pretty much on. The model, when you get like something, you can do that online.
I have to go over the tenancies like before.
Yeah.
Yeah, that's when I started. Master degree administration. It took me 2 years before
deal structure.
But, you know, multiple choice, hopefully.
Yeah, I think, I mean, you can put similar terms and you can just.
Yeah.
No, not really. What it's looking, depending on how much excess paid.
That's liquidated damages we say. That's specific performance, that's like a suit, so that you have to perform the contract. Yeah.
The whole state.
What's a bad quality course, that's like, somebody defaults or?
Old folks home. About 3 hours when I work, and he's getting ready to run an old folks home.
3 hours north or 3 hours
I think north.
So he's in Orange County?
Yeah, I think it's
No.
I don't know exactly where he is.
So it's letters.
Yeah.
I think that's in 3 hours.
Yeah, I took the quizzes.
But I'm not sure.
Albany straight up.
That's what I'm saying. I don't know. Because sometimes I would like go crazy to get the numbers and stuff, and then you know it was not that important.
What I think?
Gloria Fernandez has some very nice things to say about you. So Gloria Fernandez had some very nice things to say.
Where you find
Yes.
I would just go to the best area.
Oh, it's legal time, but no, I hear about someone that has my wife.
So I've been friends with him for 18 years.
Actual about Make sure
Hand model.
Okay, we're gonna get started here in a couple of minutes. We're obviously still waiting on a couple of people. I've given you 2 handouts today. One is a blank one that's been filled out. The one that's been filled out should match what is up here on the screen. While we're waiting on the other people to get here, why don't you just sort of take a look at it, see if you can start kind of figuring it out on your own. You're welcome to obviously talk to the people that are around you, and I'll obviously wait for my explanation of it until basically the other folks kind of get back in here. But just give you a little bit of a head start. The yellow cells are the input cells, everything else is an output cell.
Could it be possible that you send us over like through email this Excel sheets and like in the last week?
I think it's $20.
Maybe.
At the end of the semester, absolutely.
Okay, cool.
You got the lady for public.
Okay, I think that's right. Okay. No one's next to you, Ken? No, everybody else over there? Okay, all right, so we're all back. All right, so the last little half of what we have to talk about is deal structure. All right, and in my opinion, this is the part. It's probably one of the most creative elements as it relates to sort of real estate investing. Because this is the whole thing of where, and what we're going to be going over is a really basic, simple, straightforward kind of deal structure. But what you're going to find is that the deal structures that you potentially can come up with are virtually infinite, okay? In terms of, because here's what deal structure boils down to. Okay, who are the partners in the deal? Okay, in this particular example, you've got 2 people. You've got an investor developer, and you've got an investor partner. And we're sort of assuming that the investor partner is kind of like a silent partner. They're just sort of providing some money, all right? And the developer is the guy or gal who's doing all the work of getting everything put together and you know, taking care of really all the on-the-ground kind of functions. But think about all the different ways that you could make that more complex, just on that one piece. You could obviously have multiple developers. You could have multiple investors. But they can all also not be on the same level. You could have a senior developer, then with several, you know, junior developers underneath them. You could have sort of a senior partner with each partner contributing different dollar amounts and getting sort of different payments and so forth. Because here, this fundamentally, what this boils down to is who is involved, when do they get paid, how much do they get paid, what sort of incentives or disincentives are inherent within the deal structure to motivate them in one direction or the other. And so all of that taken along with, it gets more involved in what we're going to go over of what are the different tax implications for the different investors. You know, what are the different motivations for the investor themselves beyond money. It may not be money. It may be, or maybe not making a lot of money. They may just be, somebody be looking at it, here is a place to park my money, get a relatively low fixed rate of return. They don't want to be bothered with anything. They just want mailbox money, you know, to the kind of investor that's going to be much more, you know, involved in decision making and that sort of thing. So keep all of that in your mind whenever sort of beginning to work through the actual mathematics of the deal structure itself. So let's just sort of start out with the basics of this deal. All right, we've got a project, we bought it for $1 million. Potentially, we're going to sell it at the end of year 5 for $1.1 million, so $100,000 capital gain, if you will. Whenever we acquired it, we ended up getting a loan on the property for 80% of the value of the property. Okay, so far, nothing unusual about this, you know, all that makes perfect sense. Interest rate on the debt was 5%, okay? Now the one thing with this particular example, on purpose I did kind of what Cole was referring to, and that is, this is an interest only sort of loan. And the reason I did that was for simplicity, okay? All right, so 5% loan, or 5% interest rate on the loan. Then your equity would obviously be 20%. Now you see that that is not an input cell. If you put in anything here, that is going to basically subtract it from 100% to give you whatever the remainder is, okay? So just make sure that you're sort of following what I'm saying. So if we go up here and we change the 80% to, let's say, 70%, that's now going to change the equity percent to 30%, okay? Everybody cool with that? All right, so let me go back up like that, back to 80. Okay, so the equity percent is simply, yeah, what is the amount or percentage left over that we are going to have to put in as equity into the deal, knowing that we're borrowing 80%. But now, this is where we make a departure from everything we've talked about, okay? Kind of from this point down. Because now what we're saying is, all right, of that equity that we're putting in, where is that equity coming from? All right, and in this case, we have two different players in the deal. We have the developer partner and we have the investor partner, okay? So in this case, what we're saying is the developer partner, they're gonna put in 15% of the 20%. Okay, that's not 15% of the total, that's just 15% of the equity. Whereas the investor is going to be putting in the remaining 85% of the 20%. Does that make sense? Okay, so just to kind of illustrate what's sort of going on, let's see if we can kind of scroll down here maybe a little bit. All right, So in this case, if we've got the $1 million purchase price, that means, and we had 20% was equity, that means 200,000 was equity, yes? Okay, so we have 200,000 equity. Let's kind of scroll down. So what do you see in year 0? On your sheet, on the board here.
First,
You see, basically the developer, their 15% is 30,000. The investors, 85% was 170,000. The total project equity was 200,000, or once again, 20% of the total million. Does that make sense? Yes or no?
Yep.
Okay, does everybody see the connection there? Okay, 'cause it's really important that you see that connection. All right? All right. So, that's where the equity piece is coming from. Now, so far, you see all the input cells we've had up to this point. Okay, so now, the next input cell that we've got to populate, or really the only, well, not the only remaining input cell, but the ones that's going to drive a lot of the things from this point forward, is what is the project yielding on an annual basis with respect to its net operating income, okay? Now you're saying, well, where are we getting that number? Well, just like you would with any project, you're gonna say, what are my rents, what are my expenses, and what am I left over with for net operating income? All right, so for this property, 60,000 is gonna be your NOI, and then from that, in this case, what we're going to do, C3, I'm trying to remember now, all right. C6, loan to value, and C7, interest rate. Okay, yeah, okay, I don't remember what I did. Okay, so the debt service is simply going to be your purchase price times the 80%, or would be 800,000 times the interest rate on the debt of 5%, that's going to give you 40,000 here for the projected annual debt service, okay? Interest only. Make sense?
Can you do that?
Okay. $1 million is your purchase price. 80% loan to value, so that means 800,000. 800,000 times the interest rate of 5%, 40,000. Okay, so that's just the interest expense or debt service on an annual basis, interest only. Okay, everybody with me? So that means after you have paid your debt service of the 40,000 and you had an NOI of 60, that leaves you with before tax cash flow, which is money that basically can then be distributed to the developer and the investor of 20,000. Okay, is everybody with me on that? Yes or no? Okay, so now the question is, how does that 20,000 get distributed? Okay, so this first concept, pari passu, okay? More than likely you had probably never heard of those words before reading the book or today if you haven't read the book, okay? Pari passu simply is the term that is used to describe basically proportionate distributions based upon your input. So in other words, if you put in 15% of the equity, you should get 15% of the return. Okay? If you put in 85% of the equity, you should get 85% of the return. In other words, it's proportionate or equal sort of distribution based upon the proportionate contributions. Okay? Make sense? That's all it means. Pari passu. What you put in is kind of what you get out proportionally to what you put in. Okay? Everybody good? Yes? Okay. All right. Now, so in this case, the 3,000 and the 7,000, okay, or 17,000. If you add those two up, that's the 20,000. Yes? Okay. But it also represents basically their proportionate amount they put in terms of the equity. Okay? 15%, 85%. Okay, is everybody with me on that? Okay, once again, you might want to write that down on your paper because you're going to probably have to do this by hand. Okay, all right, so that's where those are coming from. Okay, sale proceeds, pari passu. All right, so in this case, oh, yeah. Okay, I had to think about that for a half a second. Okay, all right, so on the sale proceeds, if you add these two up, you get 300,000. Okay, but where are those sales proceeds coming from? Okay, they're coming from two sources. One is the property went up in value, yes? How much did it go up in value? 100,000. So 100,000 of that 300,000 is due to price appreciation. The other 200,000 is simply whenever you sell the property, you get to cash out your original equity, the amount that you originally put in. Yes?
Okay.
Okay. So in this case, how much did they originally put in original equity?
200,000.
200,000. Okay, because of the $1 million original investment, 800,000 was debt, 200,000 or 20% was equity. Yes? Yes? Okay. So what that means then, upon sale, 15% of that 200,000 plus the 100,000 in capital gain, or $300,000 total, is going to go then proportionally to the developer and to the investor. 15% of 300,000 is 45,000. 85% of the 300,000 is 255,000. Does everybody see that? Yes?
I'm sorry, can you go back? Just repeat that.
Okay. Yeah. Unfortunately, it's not, I can't really write on this, so it makes it a little bit more of a challenge, but okay. So, okay, so you understand that we have 200,000 of our original equity, yes? You understand that we have a $100,000 capital gain, yes? Okay, we add those two up, we get 300,000. Okay, so based upon the pari passu distribution, that means the developer is going to get 15% of the 300,000. The investor is going to get the remaining 85%. Thus, 45,000 for the developer, 255,000 for the investor. Okay, everybody with me? Now keep in mind, this is the simplest of all deal structures, in the sense of whenever you have more than one player. I mean, the simplest is just the singular developer, investor by themselves with a lender. But now we're starting to do these splits, and we've got to be able to calculate, well, what's the proportionate input and output. Okay, so what we have now been able to kind of generate based upon all of that, those are kind of the initial calculations that we need to use to then populate what is that going to translate into in terms of cash in, cash out for each of the partners and for the project as a whole. Does that make sense? So that's where that next piece comes in. Okay, so the very first line for year 0, that represents the equity contribution. Okay, for the total project it was 200,000. Yes? Okay, but the developer's portion of that was 15% or 30,000. The investor's portion was 85% or 170,000. Okay? So you just add those two up to get obviously the total. Okay? Then the subsequent before tax cash flows for the next several years, your total before tax cash flow up here, 20,000.
I have a question, quick question, just to go back a bit, sorry. How did you calculate the annual debt service again? Which one times?
Okay, 1 million
Yeah.
times
0.8.
80% times 5%.
Yeah. Okay.
Okay. All right. So at this point, for like years 1 through 4, you know that you've got the before tax cash flow of the 20,000. Yes? Okay. But you've got to break it out in terms of their proportionate contribution. So in this case, 15% of the 20,000 or 3,000 goes to the developer for each year. 17,000 or 85% of the 20,000 goes to the investor for those years. Okay, is everybody good at that point? Yes or no?
Yes, sir.
Okay. Then for the 5th year, we say, okay, year 5 plus reversion. Okay, year 5 is simply going to be the 3,000 and the 17,000 and the 20,000, but simultaneous with us getting that year 5 cash flow, we are also selling the property and basically cashing out our equity. Does that make sense? So for that year, that's why that for the reversion piece, in other words, the sale piece of that is a total of 300,000, but 20,000 of it is simply the cash flow. Does that make sense? Okay, so of that 300,000, then basically you're saying that 45,000 is the reversion plus the 3,000 for the year 5 cash flow equals our 48. Okay, everybody with me?
You lost. Sorry.
Okay.
Cash flow plus the
Cash flow plus the reversion. Okay, so in other words, all we're doing is just we're doing some simple addition here. Okay, so for the year 5 reversion, the year 5 plus the reversion is simply saying we're taking the 3,000 plus the 45,000 gives us 48. We're taking the 17,000 plus the 255,000 gives us 272,000. Okay? And then we're taking, in essence, 20,000 plus 300,000 gives us 320,000 for the total for the project as a whole. Okay? We don't even really have to have this column over here for the total project. That's just so that you can kind of understand what is basically comprising that. Okay? Because it's pari passu, equal in, equal out. What we see is then after putting in those cash flows, cash in, cash out, in the sense of we're cashing out, we're getting money, you know, as the developer in this, all of these are income streams to us. So if we put this in, if you put this on your financial calculator right now, let's just do that, so because you're gonna have to do it, okay? So you might as well just do it. All right? You're gonna put in basically 1 payment per year, because that's how we have it set up here. So 1 payment per year. Then you're gonna put in 30,000 as a negative cash flow. You're going to put in 3,000 as a positive cash flow, 3,000 again, positive cash flow, 3,000 again, 3,000 again, and then 48,000 as a cash flow. And then you're going to simply solve for shift internal rate of return, and you should match up with the 17.11.
Do you mind writing down the steps on the board if you don't mind?
Okay.
Where's the IRR?
Under CST.
17.11%.
You can save yourself some steps there if you want to by putting in that 4 times. And then put in the final 48,000. And then solve for internal rate of return. And you should end up with a 1711. So try it out. You're going to need to do it on the quiz, so you might as well get used to it. If you're not getting it, check with your neighbor and see if they can help you out real quick. While you're at it, you might as well do the same exact thing for the investor and for the overall project. You should get the same answer for all 3 because they're all 3 the same proportionate sort of inflow and outflow, equaling 17.1%.
What does the BTIRR, what's the BT stand for?
Before tax.
You do 2 decimals here.
Yeah, you can.
How do you put it only for 2 instead of always 0?
Oh, you probably want to keep it all zeros, honestly. Yeah, I would. It's, then it's not going to round off. Okay, has everybody got that? Yes or no? Okay, so what that should illustrate to you is, okay, that just gets us down to, once again, calculating our before tax internal rate of return. So for pari passu, equal in, equal out. All of the returns are equal. They should be. If you put in a certain percentage, same proportionate income, you should get the same return. That's all that's saying, okay? Everybody good? Yes? That's simple. Almost no deals are going to be pari passu, okay? Because everybody wants something a little bit different, okay? And this is where now I'm going to talk a little bit about some of the different ways that it does become different. You may have an investor that says, I want absolutely nothing from operating cash flows. And you're saying, why? It may be, for tax purposes, they don't want any ordinary income because it's going to be taxed at too high of a rate. They would much prefer to only have capital gain income because that's going to be taxed at a lower rate, okay? So what they may say is, all right, you as the developer, you keep, for the most part, the operating cash flows, or a very large percentage of them, or maybe all of them. Again, that's their prerogative. But at the time of sale, as the investor, I get virtually all of the capital gains. Okay, now that's kind of one extreme. Okay, now very few are going to probably be quite that extreme. But what does that then do? Well, for one, it's going to probably incentivize the developer investor to do what? To try to maximize the operating cash flows during the time of ownership. And they could really almost care less about what the capital gain is, because their motivation is all about how much money can I pull out of this thing over the next 5 years of ownership. You follow me? Whereas, you know, the investor is just sitting over here waiting patiently for 5 years and then hoping, you know, money's going to come raining from the sky, you know, for them, for their capital gain piece. Okay, does that make sense? Yes or no?
Yeah.
Somewhat.
Okay.
I mean,
Well, no, I'm not saying it's going to be structured. I'm just saying everybody has a different way of wanting to do it. Okay. It may also be that the developer may only put in a small, if almost non-existent dollar amount up front, and their return is going to be on the back end only whenever the property sells. What I'm saying is it can be structured any possible way your brain can envision it, depending on what it is you're trying to accomplish. You know, you as the developer with your investor partner. Everybody is different, okay? Now, what we're proposing in this particular example, if we scroll up the page a little bit, so this next piece is totally divorced, if you will, from that previous little set of calculations. It's a new set of assumptions, okay? The new set of assumptions are, we're going to give a preferred return to our investor partner of 10%, and then whatever is left over is then going to be split between the investor, excuse me, and the developer. And in this case, it's basically proportionate to what they put in. So it's still kind of pari passu, but we're giving a preferred return to the investor partner. So let's just sort of see how that works out. Let's just kind of, now this is where the beauty of having obviously the model right up here in front of you to be able to kind of tinker around with it makes some sense. If we get rid of the preferred return, okay, now it's just basically, it's really the exact same scenario, okay, as we had previously. Okay, so let's before we start messing around with this preferred return, let's just talk about the distribution, okay? So right now, the distribution is set up proportionate to what they originally put in, yes? But now, we sort of say, well, what if we want to make it 50-50? Okay, if we make it 50-50, see where that begins to sort of change things. Your initial contribution up here, that part has not changed. But what is changing is basically everything down below in terms of how the money is being distributed with respect to the operating cash flow as well as the distribution on, excuse me, on well, the reversion is staying the same, okay, because I think we're keeping that the same, okay? All right, so let's just say we make this 100%, just for fun.
Mm-hmm.
All right, so if the investor gets to keep 100% of pretty much everything, the only thing that the developer gets to keep is their original $30,000 investment, okay? They get that back at the end of all of this. They don't make anything, okay, in terms of the rate of return because they're just getting back what they originally invested, okay? And the investor is basically getting everything, so they end up with a 19% rate of return, okay? Now, let's just say we do just the opposite. Now this is where it starts getting interesting. You say, well, whoa, wait a second, why is this number so much bigger? It's so much bigger because they put in so much less. You see? Less money, but yet the magnitude of the effect of how much money they put in relative to how much they're getting out of it is huge, okay? All right? But the overall project is still yielding the 17% return. It's just that you're basically stealing money in one sense away from the investor, okay? So this is why, you know, modeling this becomes, you know, so important to, you know, in terms of the distribution. So we said, okay, and the original model was this. Or I'm sorry, no, it was the opposite, I'm sorry. 85. Yeah, there we go. So that was the original model, which you don't, well, the model, in other words, this model, right above it, okay? The model that we have in front of you is basically saying we're giving away a 10% pref return. Okay? And let's see here. All right. So what does that do to us? It kills the return to the developer, gives the investor really just incrementally not that much in terms of a percentage rate of return. But how is that really being calculated? What's really happening there?
They're taking 10% of the projected 3,000, and then the rest is being given to the investor.
Okay. All right.
No, you're giving
How much,
20%
okay,
of the 20%.
excuse me,
20% of the 20
How
plus
much-
the rest divided.
okay, the equity investor is putting in 170,000, correct? Okay, 10% of 170,000 is what? 17,000. So in essence, let's do it this way. Let's put in, or actually we can do it the other way around.
No.
Okay, there we go. That makes it a little bit easier to sort of see. All right, so if we just give the preferred return to the investor, but we give them nothing, otherwise the rest goes to the developer, then, excuse me, they're getting 17,000, which is just the 10% off of the 170. Does that make sense? Okay. So the pref return to the investor, why would you give a pref return? Let's just sort of talk about that for a couple seconds. They're the money person, so, but
They want.
what are you trying to achieve with this, I guess, is what I'm asking.
Incentive,
For what?
investing, or taking a risk.
Okay. What else? What other, walk me through it.
If I'm gonna invest this amount of money, I need to have this amount of return.
Yeah, that's what they want at least. That's
Okay,
like return because
but
they're
it's
investing.
also, preference also implies something else. They get paid first. Okay? That's why it's called preferred, because they get their money before anybody else gets paid. Okay? So they're first in line. Okay? So they're first in line. They get, in this case, 10% or 17,000. Now, if we change that 10% to something else, we could say it's 5%. Okay? You follow? So a 5% rate of return on 170,000 is 8,500. I'm purposely I'm pushing everything that remains over to the developer, okay? Just to sort of show what the impact is. Now so in other words, if you set your pref too high, like let's just say we set it at 15%, let's see what happens. Now we got a problem. Because the problem we have now is our pref return not only eats up all the dollar amount, but it puts us at a $5,500 deficit. Okay? Over here for our developer partner. Okay? But, and you can pretty much not trust the rate of return over here too much, because we've got all these negative cash flows, and sometimes the calculation there gets a bit wonky. But the point is, let's just say we lower it down to 12%, we lower it down to 10%, let's make it 11, 12, 11.5, oops.
Trying to get 0?
Yeah, I get pretty close to it. Anyway, but let's put it back at okay. Put it back at 10% here. Okay, so put it back at 10%. Once again, after we've met that threshold of the preferred return of the 10%, we're saying, with what I've got up here on the screen, all the remaining cash flow, well, if your total cash flow is 20,000 and you're paying 17,000 to the investor, what does that leave you with? 3,000. Okay? Is everybody comfortable with that? Yes or no? Okay, now, if all of a sudden we make this 50-50, okay, so think about the math here in your head for a second. To make that 50-50, then that says, okay, first of all, they are going to get 17,000. Well, 17,000 from 20,000 means 3,000 left over. Well, that 3,000 left over then gets split 50-50. So 1,500 of that 3,000 goes to the developer. The remaining 1,500 goes over here. So this is really what? 17,000 plus 1,500 left over. Okay, are you with me on the math?
I have a question. This model, I mean, the reversion, it's being
We
displayed.
haven't got to
the
the
same way?
reversion yet.
Okay.
Can you repeat the last calculation?
Okay. Okay, so for the investor, under this scenario, they are going to get, first of all, their pref return of 10%, which is simply 17,000. That's 170,000 times 10%, 17,000. Plus, they're going to get 50-50 of whatever is left over out of the before tax cash flow. So in this case, there's 3,000 left over to distribute. Well, 50% of it's going to go to the developer, which is 1,500. The other 1,500 is going to go to the investor. Okay, so this basically represents 17,000 plus 1,500.
So the investor's getting their 85 plus an additional 15% or 10%.
The investor is getting a 10% fixed preferred return, which represents 17,000.
Okay.
Then they are getting 50% of whatever is left over, which is $3,000. It's left over, but they're only getting half of that. Half of that represents $1,500. So they're getting 17,000 plus 1,500, which is 18,500. Okay, now here's the thing, and I mean this in the best possible way. I don't mean this in a negative way. You see how challenging this becomes? And this is a simple one. This is a simple one because, you know, this is the sort of thing of trying to wrap your head around what specifically is happening, why it's happening, you know, who really is benefiting from this the most, you know, under what conditions do they benefit, makes all the difference in the world, you know. And as I said, this is simple. I'm not saying it's simple in the sense that you should immediately understand it. I'm saying in the world of deal structures, this is simple.
So in other words, the way you do this calculation is that you first take out the pref.
Yes.
After the pref, then you go to distribution
And
of the remaining capital.
Right. So once again, let's just say that we have the pref and the investor gets nothing out of what's the leftovers. That's where they only get the 17,000. They're only getting their pref. The developer's getting everything else because they're getting zero additional. But now if they got, once again, if they got everything, so to speak, then that's what they would end up with. They would basically end up with all of the cash flows, and all the developer would end up with was they put in 30,000, if they got back their 30,000, no profit. Okay?
Okay, so then number in line 5, basically the reversion included of the sale, it's split up the same way. Like just 170, it's not it from whatever they put in.
Right. Because of the reversion is still the 300,000 total. It's 200,000 of the equity reversion, and it's 100,000 of capital gain. And then it's just a question of how it's split. Well, if it's split pari passu, then in essence, you know, they're going to get 30, you're going to get 170. Okay.
Could you click in the year 5 reversion just to see what did you put in the formula? Like
Okay.
the year 5 for the reversion? And just in the bottom? Right there. Okay, makes it, no, I can't, yeah. Okay, I won't be able to follow it.
Basically, all you're doing is you're having to back solve into what the number is. But the simplest way to approach this, trying to make it as simple as I can, you start with the pref. You calculate the pref, you get whatever that dollar amount is. Once you have that dollar amount, then you layer in, okay, now what is left over, and layer that on top. Okay? Make sense? Okay. So with your example that is written out in front of you, put it back to the way it was. All right, so under this scenario, let's try to sort of recap what is sort of happening here. All right, so describe to me how or if this scenario makes any sense.
The investor's getting their 10% of the 170.
Yep.
Plus 85% of the remaining 3,000.
Yep.
From distribution, and
Yep.
85% of the reversion as well.
Yep. So basically, you're not incentivizing the developer to do squat in this scenario.
Lovely.
Okay? This is like the worst, not worst possible deal, but this is a bad deal for the developer because all they're really getting is what they put in terms of the 15%, you know, sort of distribution, you know, kind of at the end, and they're getting just, you know, the leftovers, you know, here, but you're paying the investor this preferred return up front, so it's pretty much screwing them out of, you know, a reasonable sort of rate of return. They're only getting, based on the money they're putting in, a 9.73% return, and so the developer basically is walking away with very little. Or are they? Okay, so here's the missing piece of this. The developer may be charging a fee.
Or fees.
Or fees during the operation of the property that come out before, as operating expenses before the before tax cash flow. So that we don't even account for in this model because this is the cash flow distribution model, you know, from an investment, you know, perspective, okay, not necessarily from the operational side. Does that make sense?
Yeah.
Okay, but I'm not saying that's what's happening. I'm just saying that is another piece to be considered, that it may very well be this is not the only income the developer might be receiving. They might be receiving fees that are operating expenses, but we don't know that with this.
Would that be the place where in a waterfall, you're going to introduce like clawbacks for incidentals, vacancy increases, and all that?
Anything and everything your mind can possibly generate. That's what I'm saying. It's the most creative part of the real estate investment process is figuring out how to set up a deal structure. But here's the thing, just because you set it up a certain way doesn't mean your partner or partners are going to agree with you. Okay? You know, it's a situation of, it should be about, number one, what's fair. Should be. I'm not saying it is, I'm saying it should be. No, and that's a very delicate subject. You know, in terms of fairness, you know, because you always have this constant tension that if the investor is merely a money person, how much say should they have in the deal? Also, how much work are they really doing as it relates to the deal, or are they just pretty much just sitting back collecting checks? You follow what I'm saying? You know, an active investor versus a passive investor. And so fairness, you know, then begins to be this kind of muddy water of, you know, if Connor is contributing all the money into the deal and Cole is doing all the legwork, you know, the day-to-day operations, getting everything set up, getting everything done, Cole is just sitting back collecting checks, Cole's probably not going to be too thrilled about giving Connor, you know, too much or too high of a rate of return because he just sort of sees Connor as really not doing anything other than giving him money. But yet, could Cole do the deal without Connor? Probably not, because he doesn't have the money to do it, can't find any other sources to do it. So the fact that Connor is his only source of capital, you know, what's fair. You follow what I'm saying?
Yeah, yeah, yeah.
And so that's the part that gets very complex with all of this is, you know, that tension in some cases that arises between, you know, basically the developer doing all the work and the money person, you know, sitting back basically collecting interest or collecting a preferred return or whatever it might be.
In a situation like this, where the investor is receiving the bulk of the returns,
Yep.
wouldn't he be better suited just to go into a REE where he's gonna, you know,
Possibly, yeah.
because if you're gonna take the tax brunt, might as well just invest in a
No,
REE.
I mean, and I don't disagree with what you're saying. What I'm saying is, in each of these situations, it's going to be different. All depending on what they bring to the table. I have known personally developers, you know, who were one-person shops, who hired out every component of the development, you know, in terms of doing all the groundwork and legwork, but the developer themselves was just the what I would call the coordinator of everything, okay? But then they had a silent partner based in South America that was providing all the funds. And that silent partner in South America wanted nothing to do with anything related to the operations of the project, just simply wanted a fixed rate of return, and that's all they wanted. But I've also seen it where, you know, like this, they want some sort of not only fixed rate return, but they also, you know, want a larger than normal size of the pie, because they say, well, you wouldn't be able to do this without me. Or I am contributing something of substance and value. I'm helping you find your tenants, or I'm doing this or that or the other thing. Okay, Edward, you had a comment.
Someone came to me once with a similar deal like this. His investor was putting up all the money and wanted 80% of the profits and the proceeds. And he asked me to evaluate it. And I told him it was a great deal. He wasn't putting up a dollar. And I said, only ask two questions. One, how soon can you close on fund? And two, get a buyout number. So if he wanted to buy it out after 10 years, 15 years, you know? So,
it all ultimately comes down to, for both parties, you know, what is fair. The developer, if they're the ones, that's the thing, we keep sort of making the assumption that the only person doing any work is this person. But we don't really know that. This person could be contributing something more than just simply providing the money.
making connections.
You know, whatever it might be. But we don't, you know, all we're trying to illustrate with the example, what are some of the possibilities to think about? You know, how might the changing of this deal structure make things behave differently because you're incentivizing or de-incentivizing certain behaviors. We would like to think, I mean, the rational economic man that they talk about in economics, you know, is going to always be looking out for their own financial best interest. Yes?
Absolutely.
There are those people out there that are maybe a bit more altruistic, you know, that maybe are looking out for the betterment of everybody else and that sort of thing. But most people are probably selfish. And they're going to react to incentives and disincentives accordingly. That, you know, there are probably going to be very few developers who are going to step into a deal like this and say, I'm going to accept this sort of rate of return for doing all the work. Okay, cool.
So when you raise money for a deal like this, and you get the financing at 80%, will the bank finance the construction loan at 100%, or do you have to raise some equity for the construction loan as well?
It depends. It just depends. That's all I can say.
On what?
On that lender.
Okay.
And
It's
what they're
not
willing to
unheard
allow.
of.
It's not an absolute.
It's not unheard of to get 100% financing on
It's not
construction?
unheard of. It's unlikely.
Okay.
I am a believer that almost anything is possible. I've seen a lot of weird stuff, you know, good and bad, and all I'm saying is that, yeah, in a normal situation, no, you're probably not going to find that.
What is like the, probably not a loan to value, but like what is the?
It may be, okay, like for example, I'm trying to think of the best way to sort of, imagine that you are, because I've seen this, you're a lender in a small community. There's a developer that's done a lot of work in that small community. Everybody is chasing that developer for their business. So lenders will go and just literally say, please come, get a loan at my bank, and I will give you almost anything you want just to get your loan. You know, that's what I'm saying, you know, but that is not a normal situation. That is kind of, it's like a weird, you know, kind of confluence of the universe to have something like that happen. But does it happen? Yes, it happens. Okay? Or you have a local government that wants something to be built or something to happen, and they figure out some weird, crazy way to structure the deal to where the developer doesn't have to put any of their own money into the project, and the project gets built, and the developer, you know, walks away, you know, with a pile of cash. But they are subject to a whole bunch of restrictions on what they can and can't do. Okay? Kenny?
When structuring a fund, does this have to be created and then audited with a fund?
Okay, in what context? I mean, if it's like, I mean, when you're saying audited, for whose benefit? The partner, the investor, or for?
Let's say everybody, or anybody.
Well, okay. If you and I are partners in the deal, how much do we trust each other? How much do we need to have this reviewed? That depends on what we choose to do between us.
Mm-hmm.
But if this is more of a situation of, yeah, where this is, it involves obviously a wide variety of people, then yeah, it's more than likely going to need to be, you know, audited. And it's going to be required. It's going to be probably audited in order to make sure that you're, you know, everyone's being honest.
Especially when it's being sold off by shares.
Right.
And
Okay. Any other questions? Okay. Let me take a look and let's make sure that there's anything I'm missing.
Yeah, that was complicated. It was complicated.
Okay, so we got through the pari passu stuff, we got through residual splits. The hurdle rate is essentially, I mean, we know what the hurdle rate is in the sense of, you know, whatever the required rate of return is, did they meet that return? Did they not meet that return?
that was a 1711.
Yeah.
Isn't the hurdle rate the prep?
Well, whatever, yeah. If the hurdle rate could be to simply, did we meet the rate of return here for the pref? It could also, I mean, depending on how it's worded, but in essence, like, for example, in this question, I'll read you the question that I asked. I'm not going to read you the numbers, but calculate the developer partners and the investor partners before tax and internal rate of return on this deal structure. Assume that they both have a hurdle rate of blank %. Did they meet or exceed their hurdle rates? So in other words, that's just simply saying,
Hurdle is preferred?
like up here,
What's hurdle?
if our hurdle rate were 15%, did they meet or exceed their hurdle rate? Yes or no?
Yes.
Yes. Okay, that's it. Simple as that.
So as long as the internal rate of return is higher than the hurdle rate.
Yeah, they met it. If they didn't, they didn't.
So in a model, then the hurdle rate would be NPV is 0. Is that how that works?
Yeah, pretty much, yeah.
Okay.
Okay. Pref, yeah, blah, 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 blah. That's okay. Yeah, I think we've pretty much got it.
I have a question.
Yep.
So just the last part, just re-explain one.
Yeah, I mean, what do you consider the hurdle rate again?
I have to give it to you.
Oh, you'll give it.
Yeah, if I say the hurdle rate, like I said,
Okay,
if I
gotcha.
said, assume that the hurdle rate
Okay, that's.
is 15%,
Gotcha.
okay? With this scenario,
Need it or not, whatever.
they did not meet the hurdle rate.
Yeah.
They met the
Yeah.
hurdle rate and
Yeah.
exceeded the hurdle rate.
Yeah.
The overall project exceeded the hurdle rate. Okay? Okay? Yep. Okay, promote. promote? What does a developer's promote? The term, what does it mean?
The fee, right?
No, it's the incentive rate that they're giving out to the investor.
I don't know, that's a good question.
It's really more to the developer.
It's like his fee, no? On,
Yep, go ahead.
That's all I know. That's where my knowledge stops.
Okay. So the promote, thus the term promote, is you're giving some sort of an incentive to the developer to promote the deal. Okay? In other words, think of it like this. If you're the investor and everything is totally pari passu, yes, the developer has some modest incentive, obviously, to get their pari passu distribution and so forth. But if you really want to hyper incentivize the developer, you also give them kind of what's called a developer promote. And that is basically anything and everything that they can do to basically ensure that this project is as successful as it possibly could be. That is an additional sort of piece that you offer to them. Okay? So, in taking a look, let me see how I have the structure so I can help you out with this. So in this case, the developer promote is simply going to be, if it's pari passu, the developers promote for this one down here. Let's just take a look at this one. All right. Let's say this is 0 for a second. And let's say that we do this non-pari passu. We do this, let's say 50-50. All right. Now, how might you answer the question the developers promote over here in year one? What dollar amount, in essence, would be, or percentage would be their promote? Think of it like this. What would be the amount? What would be the amount or the percentage above and beyond their pari passu they're getting?
7,000.
Okay, so 7,000 would be the promote.
I thought you just said this wasn't pari passu.
Okay, I said, what amount would they get above their pari passu is the promote. So if the pari passu were 3,000 and they're getting 10,000, the promote would be 7,000. It's the amount above and beyond their pari passu.
So it would be, doesn't the promote, like once they reach the hurdle rate or whatever rate?
You can have it set up a whole bunch of different ways, but for the purposes of my simple little example, I'm just saying how much above and beyond for the first year would you get?
Okay.
And so basically what we're saying is we're paying the developer $7,000 basically more than the pari passu in order for them to promote the property.
In other words, they're getting their 10%.
We're not getting 10%, they're just simply getting their 3,000, which the pari passu they would get, plus 7,000 in this deal.
Which would be their 15% of what they put in.
Correct.
And anything over that
is the promote.
Yeah.
In other words, their incentive. That's all it really is. It's, you can call it their incentive, you can call it promote, you can call it the above and beyond their, above and beyond their pari passu distribution, whatever you want to call it, but it's what money are they basically being given that maybe you could sort of make the argument that the whole reason they're being given that extra money is because they're working their tail off in order to make the property that much more successful. Does that make sense? Okay? We good?
Can you give the numbers again, the example that you gave? You
Okay.
said it's 3.
Once again, in this scenario, how much would the developer ordinarily receive per pursuit? $3,000. Under this scenario, they are getting 50% of the total distribution. So the reality is 7,000, the difference between 10,000 and 3,000, okay, is their promote. That's the extra that they're receiving, okay? In other words, oops, reversed it. Ordinarily, with the amount that they had put in, which is 15%, they would be getting 3,000.
Yeah, I see.
Okay? But because we are giving them a preferential split of 50-50, now their promote would be the amount above and beyond that 3,000 or 7,000. All right? If we gave them, this is 0%, what would their pref now? 17. Not pref, but I'm sorry, what would their promote? Is right now. 17,000. Okay? Make sense?
What percentage is that 17,000?
Well, it works out overall to be, it gives them an 81% before tax internal rate of return. Or they're getting 100% of the proceeds. Well, they're getting 100% of the cash flows. Okay? All right. Are you ready?
For a break.
Okay. Take a 5-minute break, come back, and then we'll do the quiz. This quiz will take you longer than probably all the other quizzes. I'm sorry, what? Right. Seven. Right. No, you of the 20,000.
Yeah, exactly. And then 85% this total, or this?
Well, okay. This represents the total amount of the reversion of the 100,000. It also is the 200,000. I'm sorry, $200,000 of capital gain. I'm sorry, $100,000 of capital gain, $200,000 of reversion, plus the $20,000 cash flow. That's what that represents. So that's 320.
So then I'll get 85%
Of
this, but it doesn't have 10%.
oh, no, because the 10% is only coming out of operating cash flow there.
So how do I get that difference from 17 to 19? That's what I.
Okay. Once again. Okay, what was the, let me see, what percentage?
Oh, it's 85 and 15. 10, 85 and 15.
Okay. All right, so what are you asking?
There's 2,500 difference between the 17th and this number. You
Okay,
calculate
so what happens is, okay. So you are getting 17,000, then you're getting, of the remaining 3,000, you are getting 85% of that. So 3,000 times 85%.
Then you just subtract that from the 20,000, right?
Right.
Okay.
Okay?
You take equity percentage, times, so for the developer, 0.15, whatever it is. Swap it here, then take this number, subtract the residual.
Well, residual is just gonna be basically, is just how much, who's getting what? Potentially, yeah.
And also you have to be careful with this, you also put this.
Yep.
I think the same question again, so the residual split would be, in a preferred example.
It's who's getting what?
Yeah.
That's all it is. It's whatever's left over.
So in that example, if you give 10%, it's 50/50.
Yeah. So in this example, basically the residual is simply is 85/15, and then they're getting 85%, they're getting 15. So I may ask for the dollar amount
So
of.
the will be 3,000.
Right. Okay. You ready for the quiz? Let's go.
That's the only thing I've been.
Okay. Type in 3,000. Type in 3,000 times 0.85. What do you get? Then add that to 17,000. What do you get?
Oh no. How about this?
Okay.